As investors continue to look for yield across the globe, emerging markets are coming back in favour. But is it going to last? Joining us to discuss the outlook for emerging markets is Arthur Karras, Portfolio Manager at Old Mutual Investment Group, Paul Hansen, Fund Manager at Stanlib, and Petri Redelinghuys, Independent Trader at Stockbroker. A very good afternoon to you, gentlemen. Let's start off with you, Paul. Looking at the numbers that came out earlier in the week at the South African economy, missing that technical recession in the second quarter, would you say that we're sitting in a much better picture right now? Much better space, would you say?
I think we are in a better space than we were, say, 6 or 7 months ago, January, February. You know, hopefully we passed the point of maximum pessimism, I think, on around the 21st of January when the stock market bottomed. I think with regard to politics, the economy, everything, I think we did pass the worst point at that stage. And things are gradually improving with a bit of pullback here and there.
And Arthur, maybe let's bring you in here. Looking at those third quarter numbers out of the economy, we're missing a technical recession, which is good news. But we did have some manufacturing numbers that came out yesterday, raising a bit of concern about the third quarter and how it may look. What is your take on the South African economy right now?
We think that people have been a bit too pessimistic. And even if we have 0% growth for the rest of the year, we're still going to end up with about 0.3% growth for the year, which is still above, I think, what the IMF was expecting in terms of a slight negative of 0.1. So the economy really doesn't have to do much to actually get some positive growth for the rest of the year.
Petri, it's been about uncertainty with the hawks after Finance Minister Pravin Gordhan. The market's reacting to that. We've seen how the rand has also reacted. But how are you playing the market at this stage with all this uncertainty going around?
I think that you make a good point. I think that we are out of favour in terms of the risk premium people are attaching to our market. If you consider the political situation, and you mentioned the battle between the Finance Minister and the President. But if you strip all of that away and you look at the sort of underlying market, okay, there are headwinds, strained consumers, that sort of thing. But we are essentially a resource producer. And if you look at what I think what's happening in the macro picture is there is a continuing demand for resources, and commodity prices are starting to lift again. It's not like we're suddenly going to stop using copper and iron ore. I think these things were hammered down on fear and on pessimism, which both the other guests have already said has perhaps been a little excessive. And if we see a continued recovery in those, we'll probably continue to see a strengthening in the rand and a recovery within the resource sector at least, which I think could be a driver for the market to trade higher.
And Paul, what is your general assessment of the global markets at the moment?
The bull market turned 7.5 yesterday. 8th of September, and it's a long bull market but still intact. The leading market in the bull market, the US, hit record highs last month. It had an unusual situation where the Nasdaq, the S&P and the Dow all hit record highs in one particular day. What happened twice in August for the first time in 17 years. So that extends the bull market, and we tend to follow the US. Even
with the uncertainty around interest rates over in the US, you still remain bullish?
Absolutely. I mean, cheapers, you've got 0.5% interest rate there, so it goes to 0.75 or even 1. Still very low.
And Arthur, Paul talking about interest rates over in the US, but what is your outlook perhaps for interest rates for the next 2 to 3 years about?
I think interest rates are extremely important when you're talking about markets. I think the key driver behind the environment that we're seeing at the moment across markets is the level of global interest rates. So we don't expect any kind of sustained strong upward interest rate cycle out of the US. We're talking about a rise in interest rates there, but it's going to be a very moderate, very measured rise. And in terms of South Africa, we think we're probably near the top of our cycle. It might be difficult for us to imagine that right now, but we think we're seeing the top of the inflation cycle, and that before too long we're going to see interest rates heading lower again in South Africa.
Well, you were talking about a bull market just a little earlier on, but what would be some of the warning signs to say, okay, hang on, we're seeing a bit of a bear market coming through here?
Yeah, look, if your interest rates go up 4, 5, 6, 7 times in a place like the US, you're getting towards perhaps 4% or even 3% in the new story, then it could be, that's usually what's happened, is the interest rates have risen too much and sent the economy into recession, sent the market into a bear market, and residential property into a dive. So that would be the big thing, is if interest rates go up a number of times, eventually reach a point that's too far.
And Arthur, looking at emerging markets, what is your outlook there?
The emerging markets are very attractive to investors globally because of something that one of you mentioned earlier, which is the search for yield. So you're getting decent yields there, and that's something that everyone's looking for. And you're also getting an improving growth picture. So much the same as what we've seen in South Africa, with a bit of a rebound off our growth rates off the bottom. You're seeing something similar happening in Brazil and other emerging markets. So we're seeing better growth and a decent yield, and that's what's attracting investors.
And Petri, would you say that our market is pretty much at an overvalued at the moment, or is it undervalued? What do you make of our market?
Well, something is only worth as much as what someone else is willing to pay for it, right? So at this point, I think from a valuation perspective, I think there are some fairly valued companies. I think there are some very overvalued companies, depending on which sector within the market that you look. If you look specifically, within sort of the retail space, they tend to be a lot more overvalued. Currently, I believe that there's a lot of value to be found and cheap companies in the resources and commodity sector. So it depends really on where you're looking. I do think, though, that in the short term, the market may pull back somewhat, just because it's the nature of the beast. But in the medium to longer term, looking 6 months to 18 months, I think we'll probably see higher valuations, and the market will continue to go higher. So I don't think that our market is overvalued at this stage now.
And what do you make of our market at this stage? Paul talking about is not overvalued at this stage. What are some of the companies that you're looking at the moment and saying, well, these really do offer value for you?
I don't like to mention specific companies because I don't actually, I'm a fund-of-fund manager, so I don't pick particular shares. But I think there's pockets of value in our market. There's certainly areas that are very expensive, and there are other, if you look at the overall P ratio of the all-share index, it looks very high at 22 or so. But there are pockets of value within the large caps, mid caps, and small caps.
And Arthur, what are the kind of values are you seeing on our markets at this stage? Do you perhaps pick companies, or is there a particular sector that you would say here, with the kind of interest rate environment that we are seeing right now, that you would say, okay, it's time to get into this sector?
Well, you're seeing the kind of thing you often see, which is that the companies that are cheap appear to have a negative outlook. So, for example, the banks are cheap relative to their own history, they're cheap relative to the market, but everyone's nervous about downgrade and about a weaker economy and the impact that will have, or a weaker consumer and the impact that will have on banks' earnings. So you can buy banks at low prices, but you've got a lot less of a positive outlook for them. You can buy some of the what we call the expensive defensives. You can buy the British American tobacco type of companies that have got much clearer outlook in terms of earnings, but those companies are expensive. They're expensive relative to the market, they're expensive to their own histories. So you can definitely find cheaper parts of the market, but you need to be able to make yourself comfortable that the share prices have discounted the potential bad news that we all know about, but we're uncertain of the impact on the companies.
And how would you say we compare to other emerging markets?
Well, I would say that we've probably got a comparable level of political risk if you consider the kind of things that have happened in places like Russia and Turkey. We've got an excellent banking system. I mean, that is so clear. Back in 2008, we navigated the global financial crisis without any of our banks needing a bailout or needing to be saved by the government. So we've got an excellent banking system. We've got really good courts of law. You can sue people that you do business with if they break their contracts, and you can expect to get a reasonable outcome there. So I think we compare quite well with other emerging markets, which is why so many of our domestic companies have got a very high percentage of their shares owned by foreign investors.
And perhaps let me just one last question to you before I return to the desk. There's also talk about this potential downgrade later on this year by the credit ratings agencies. How could that downgrade perhaps affect interest rates going forward, as perhaps maybe even growth?
A downgrade would simply make it tougher for South Africa as a country, and for companies in South Africa to borrow money. It would make it more expensive for them to borrow money. It would make it less attractive for certain classes of investors who have to invest in companies or instruments or countries with an investment rating to invest here. So it would be a drag. It would definitely be a drag. You can argue about whether it's already in the prices of the sectors that would be most affected, but there's no question that there would be a real impact on the economy if there was a downgrade.
Your thoughts on this downgrade that we could possibly get? I hope we don't get a downgrade later on this year.
I
We
don't
need to
think
do a lot of work.
I don't think it'd be much of a big deal at all, because it would be probably relate to our foreign story, which is 10% of our debt, 10% of our government debt, because the local debt is at least 2 notches above junk as we sit right now. So it's only the foreign debt that's 1 above junk. So the foreign debt gets downgraded. It doesn't affect our bond market really. It doesn't affect international holders of our bonds. They don't have to sell. So it's a knock against the door. Say, wake up, get your house in order. But it's not by no means a disaster.
And your thoughts on that, Petri?
I think the fallout, the markets are emotional beings, animals, if you want to call them that. So if the news comes that the market gets downgraded, or that the economy has been downgraded by one of the major credit ratings agencies, I do think that there will be fairly sharp and quick sell-off. But I don't know if it would last that long. Perhaps we see a similar type move that which we saw with the Brexit scenario, that everyone thought the world ends for about 2 days, and then you realize that, okay, it's maybe not the worst thing in the whole world, and it might not have the largest impact. So I think there'll be a severe reaction, but I don't think that it'll be continued. I don't think it's going to destroy our economy. Also, I think that if you look at the current situation, I think there's only really one thing that will guarantee a downgrade at this point, which is if we lose our finance minister. Provided that doesn't happen, I don't think we will be downgraded.
And talking about a Brexit, are we ever going to get a Brexit? Is it going to happen in your view, Paul?
No one knows. I don't even know if the Prime Minister of England knows. He probably doesn't, because it's going to take a long, long time to sort out, and some people think it might not even happen for 2 years, maybe even longer. It's an unknown at this stage, but it does look like the pound could be bottoming against the dollar, which is quite interesting. So
we're still in another phase of uncertainty over the next couple of years until this happens.
Oh, great opportunity.
So what kind of opportunities are you seeing there, especially for South African companies?
Well, I mean, for British companies to do business with other parts of the world other than Europe. So, they're looking to open up business relationships all over the place, apart from just Europe. So I think there's an opportunity for the British, and South African companies can possibly piggyback on that if they have operations in the UK.
We'll have to leave it there.
It's possibly quite positive.
Okay, we'll have to wait and see. Thank you so much, gentlemen, for joining us this afternoon. And many thanks to Arthur Karras, Portfolio Manager at Old Mutual Investment Group, Paul Hansen, Fund Manager at Stanlib, and Petri Redelinghuys, Independent Trader and Stockbroker. Well, that's all from this week's edition of Finweek Money Matters. Remember to pick up your latest copy online or in stores. We'll see you again same time next week. Thank you so much.